I'm certainly glad to hear some of the things that Leslie just had to say. Absolutely, interest rate environment is incredibly important for banks. And frankly, our forecast right now is quite favorable for financials. We're looking for higher yields and steeper yield curve. So as you know, generally banks, I know I'm oversimplifying, but they borrow short and they lend long. So higher rates, steeper curves is a good environment.
Now, as we talk about the hot spots or the points that you're watching, over the course of the past few days, amid the market stress, the argument has been made that there should have been a bigger bid for treasuries, given all the stresses in the marketplace. Is that something that you were watching? Did you feel as though the 10-year and 30 years reacted the way that you thought they were going to react, given the rest of the macro picture around the world?
Sure. Well, let's go back to the basics. Should there be a bigger bid? Maybe. But remember, it's not only about demand, it's also about supply. And the supply story in treasuries is actually very interesting. As you know, the government is going to run 1.1 trillion deficit this year. They're going to have to borrow a lot. And we think there'll be a big pop in borrowing, specifically in Q4. So I think investors are becoming cognizant of the fact that there is a lot more treasury supply coming down the line, even if they like yields where they are right now.
Now, treasury supply is one thing. Many of these banks that we're talking about are primary dealers. They have to bid at treasury auctions because of this relationship with the Fed.
That's right.
So, and JP Morgan, Citi,
treasury,
all are some
cash
of them.
Management
so
business.
as we talk about these, we often talk about investment banking. But what about these trading operations for the fixed income, currencies and commodities? They've always been a hot spot for many of these banks, right?
They have, although during this quarter, a lot of analysts are expecting that to be not the key driver of earnings per se. So that's something to definitely keep an eye on. It's something that we look for in all of the various conference calls, all the commentary, especially as we make our way into the fourth quarter and try and get some idea of what that could portend for the markets and what that could portend for these big banks, which of course set the tone for earnings season as a whole. So in some ways, you know, they kind of beget the rest of the earnings season.
Should we still look, Leslie, at the net interest margins, these NIMs?
Yep.
I mean, Boris was talking about this lend, borrow short, lend long. That's the profitability for a bank. Is Wells Fargo still the one that we would look at out of the three today as being the most exposed to that net interest margin story?
NIM is a big story for the quarter, indeed. And you're right, Wells Fargo is something that we should, one that we should definitely pay attention to when it comes to NIM. Analysts are looking at that very closely. They're expecting a pickup. But of course, like I said, the valuations for these banks are very depressed. So any key indicator like NIM will be one that could help catapult these stock prices higher.
Just a couple seconds left. The 10-year, where do we see it in the next week or two here?
335 by the end of this year. So probably, we'll see a gradual shift from where we are, around 320 this morning to 335. And we actually see it going as high as 370 in 2019.